Hi, I'm Bill Spalding. Welcome to WCS Money Tutorials. With real estate investment trusts, you can earn dividends of up to 16% annually, and you may be able to deduct up to 20% of that income from taxes. You can also earn substantial capital gains on top of that when interest rates decline. This video describes how REITs work, the different types, their investment characteristics, and their tax benefits. Real estate investment trusts, often shortened to the acronym REITs, allow investors to pool their money into a fund that profits from investments in real estate or by financing real estate. REITs have higher returns with lower risk than most other types of investments, and they have some tax benefits. Technically, the investment interest in REITs is measured in terms of units rather than shares, so investors of REITs are sometimes called unit holders rather than shareholders. Nonetheless, the terms REIT shares and REIT shareholders are often used. REITs do not pay any corporate income taxes on dividends distributed to shareholders if, in addition to a few other requirements, at least 90% of the taxable income is distributed as dividend payments to shareholders. Real estate investments do provide some diversification, but probably not as much as you think, as you can see from this 5-year graph of the Vanguard Real Estate Index Fund ETF, which measures the performance of publicly traded equity REITs and other real estate-related investments, and the Vanguard 500 Index ETF. You can also see that REIT prices do not change as much as stock prices. REITs have less volatility. There are 3 major types of REITs. Equity REITs invest in real estate, deriving their income from rent, dividends, and capital gains. Mortgage REITs, often called MREITs, invest in mortgages and mortgage-backed securities, so they are more sensitive to interest rates. Hybrid REITs invest in both real estate and mortgages. There are also more specialized categories of REITs that focus on particular types of property, including offices, apartment buildings, warehouses, retail centers, medical facilities, data centers, cell towers, infrastructure, and hotels, though some REITs hold multiple types of properties. REITs can also be classified as to whether they trade on a public stock exchange, whether they can be sold to the public as a non-listed REIT, or whether they are private REITs that can only be sold to institutional or accredited investors. Public non-listed REITs are registered with the SEC, but they do not trade on public exchanges. Why, you may ask, do REITs bother with the long, expensive SEC registration if they will not be publicly traded? Because public non-listed REITs are sold rather than bought. With SEC registration, public non-listed REITs can be sold by broker-dealers and their representatives, investment advisors, and financial planners to the public. To compensate them for their sales effort, a hefty sales commission of up to 15% is charged. So PNLRs have higher fees, and because they do not trade on the public exchange, are highly illiquid. So you should avoid public non-listed REITs. There is an official association for REITs called the National Association of Real Estate Investment Trusts, often referred to by its acronym. They also have an official website with a lot of information on REITs, so check it out if you want to learn a lot more. The value of REIT shares depends, among other things, on earnings and the ability to pay dividends. Since most people buy REITs for their income, the price of REITs depends on how much they pay and on current interest rates. A simple way to compare investments is by comparing their dividend yields, equal to the dividend divided by the share price. Net operating income is a better indicator of the long-term viability of a REIT, since operating income or expenses do not include one-time items such as the sale of property. Net operating income is based on regular business income and expenses, not on extraordinary items. Another measure of a REIT is the capitalization rate, or cap rate, which is the income from normal business operations divided by the value of its property portfolio. The performance of REITs are also measured by the funds from operations, which is like cash flow from operations, equal to net operating income, then adding back depreciation and amortization, since these tax deductions do not require an outlay of cash. Gains or losses from the sale of property or investments are not considered when calculating net income, because these are one-time events. So the funds from operations measures the viability of the REIT, including the ability to continue making dividend payments, since such payments depend on a steady cash flow. Interest rates also affect REIT prices in the same way that interest rates affect bond prices. When interest rates decline, REIT prices increase, and vice versa. Here, you can see how changing interest rates affected the Vanguard Real Estate Index Fund, ETF. From 2019 to 2020, this ETF steadily rose as interest rates declined. As interest rates rose during 2022 and 2023, the price for the Vanguard fund declined. Although the income received by REIT holders is often called dividends, they are taxed more like distributions from a limited partnership. There are three types of income. There is the income earned from rents and interest earned from mortgages, which is taxed as ordinary income. These dividends do not qualify for the special tax treatment that qualified dividends from stocks enjoy. However, up to 20% of this income may be tax deductible. Some of the distribution may come from capital gains, which is mostly long-term, so it benefits from the lower tax rates on long-term capital gains. Part of the distribution may also be just a return of capital, which is not taxed as income, but it does lower your tax basis in the shares, thereby increasing taxes or lowering losses when the shares are sold. If the distribution reduces your basis to below zero, then your basis will be zero, and the amount below zero will be treated as a capital gain. Income from REITs is considered passive income, subject to passive income tax rules, meaning that losses may be limited to your passive income, but this should not be a problem for most investors. If you are not a resident of the United States, then the income may be subject to a 30% withholding tax, unless a tax treaty between the United States and your country of residence applies. After the end of the year, you will receive this Form 1099, which will show the total dividends paid to you and the type of payment. The dividends of many stocks qualify for special tax treatment in that they may be taxed like long-term capital gains, even if the stock was held for less than 1 year. However, this type of qualified treatment does not apply to the dividends paid by REITs. Ordinary dividends are taxed as ordinary income. Capital gains are reported in Box 2A, most of which will be long-term. Some of those capital gains may be Section 1250 gains, which are taxed at the lower rate of 25% or your marginal tax bracket. There is no distinction between short-term and long-term Section 1250 gains. These gains result from the recapture of depreciation that was claimed on sold property. So you will gain some additional benefit if your marginal tax bracket exceeds 25%. Otherwise, it will be taxed as ordinary income. Any portion of the distribution that was a return of capital will be reported in Box 3, non-dividend distributions. The part of the distribution that is not capital gains or a return of capital may receive special tax treatment under Section 199A of the Tax Code. You may be able to deduct up to 20% of what is reported in Box 5, but the deduction is limited by your tax liability. Furthermore, this provision of the tax code will expire in 2026, so the last year you can claim it is in 2025, unless Congress extends the tax break, which is unlikely given the huge federal deficit. There are many REITs available. This is just a small sample. However, most brokerages provide screeners that you can use to find funds to your liking. You can see that most of these funds have not been doing well within the past year. This is because interest rates have been rising, which hurts REITs just like it hurts bonds. However, interest rates have probably peaked and are expected to decline in 2024 and 2025, which should help REITs perform much better in the next 2 years. You can also buy exchange-traded funds composed of REITs, such as these 7 deemed best by U.S. News & World Report in December 2023. Notice that the iShares Mortgage Real Estate Capped ETF pays the highest dividend yield. More on that later. You can also buy leveraged bull and bear REIT funds, but these are riskier due to their volatility. As discussed earlier, mortgage REITs have a higher sensitivity to interest rates. Since most investors now believe that interest rates have peaked, many of them expect that the Federal Reserve will start decreasing interest rates as soon as March 2024. This will benefit mortgage REITs more than the other types of REITs, so I believe that this will be one of the best investment opportunities for 2024. For instance, the iShares Mortgage Real Estate Capped ETF that I mentioned earlier has an SEC yield exceeding 11%. But some individual REITs have also done very well and are expected to do even better as interest rates decline. Bill Gross, the billionaire investor and PIMCO co-founder, believes that some mortgage REITs, such as Annaly Capital Management and AGNC Investments, may increase in price by 10% in 2024, while also paying double-digit yields. PIMCO specializes in fixed income securities. Annaly Capital Management, one of the REITs mentioned by Bill Gross, was paying a dividend of about 14.5%, though this will vary with the price of the security. AGNC Investment Corporation, another REIT mentioned by Bill Gross, is also a residential mortgage REIT. They pay an even higher yield of 15.3%, but as with all yields and securities, the exact yield will vary with the price. To summarize, since the main advantage of REITs is their dividends, their prices have suffered, along with bonds, as interest rates have risen. However, Decreasing prices because of interest rates also increases yields. By buying now, you can lock in high yields while benefiting from capital gains when interest rates decline. On December 13, 2023, the Federal Reserve just released its summary of economic projections. As discussed earlier, interest rates have a large influence on securities that pay interest or dividends, including REITs. Based on the latest FOMC meeting of the Federal Reserve, interest rates are now projected to decline by at least 0.75% in 2024. Some Fed observers are projecting even larger decreases. This will benefit REITs significantly. The Federal Reserve controls interest rates by controlling the federal funds rate, so investors are keenly interested in what the Fed will do in 2024 and beyond. In the summary of economic projections, investors focus obsessively on one part in particular, the so-called dot plot, which you can see here. The dot plot shows Fed policymakers' estimates for interest rates at the end of the next several years and over the long run. The forecasts are represented by dots arranged along a vertical scale, one dot for each of the Federal Open Market Committee members. Economists closely watch how the range of 19 estimates is shifting, because it can give a hint at where policy is heading. They fixate most intently on the middle or median, which is regularly quoted as the clearest estimate of where the central bank sees policy heading. The current projection is that interest rates will drop to 4.5% to 4.75% by the end of 2024. Note where the numbers fall in relation to the longer-run median projection. That number is sometimes called the natural or neutral rate, and the most recent Fed projection is that the neutral rate equals 2.5%. It represents the theoretical dividing line between easy and restrictive monetary policy. The neutral rate is treated as an ideal long-term rate, but the federal funds rate could easily drop below that if the economy slows too much. As I said, this should greatly benefit REITs in 2024 and beyond, allowing you to earn not only a hefty dividend, but also substantial capital gains. To summarize, I want to point out that the main benefit of REITs is their income. Although they do have the potential for capital gains, they will not gain nearly as much as the stock market. As you can see in this graph of the Vanguard 500 Index Fund and the Vanguard Real Estate Index Fund, ETF. However, REITs do pay a much higher dividend and should benefit to some extent from the decline in interest rates that should occur in the next year or two. Remember, the dividend yield will change with the price of the security. You should never judge a REIT based only on its dividend yield, because a high yield may result because the company is doing well or because it is doing poorly. The stock of a company may drop because the company is having financial difficulty. This will increase its dividend yield initially, but if the dividend is not sustainable, then eventually the dividend will have to be cut, which will cause further decreases in the stock price. Always investigate whether the dividend is sustainable before buying, or, for greater safety, buy an exchange-traded fund of REITs. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.